Hello my fellow freedom builders and welcome back to the channel. The other day I mentioned something about option investing in one of my videos, and I asked you to comment if you would like some more videos about options. And there was quite a lot of interest, so therefore we are starting on a little extra YouTube series here called Options Trading and Options Basics. So I would like to start telling you a lot about different option strategies, but first of all, we need to get some basics in order. So this video is primarily about the options basics. If you are completely new to stock trading and investing, this might be a bit of a deeper level, and I would recommend you starting with getting to know a bit more about stock trading and investing before moving into options, because options can be a bit of a three-dimensional piece of chess to understand, but I'll try to make it as plain and simple as possible. First of all, when we move into the world of options, we need to know that what we are talking about here is actually a question of insurance and of risk. So if I have a car and it's a new car, expensive car, and I want to insure it if something bad should happen to it, then I'm buying an insurance. I'm buying it from an insurance company, and I'm paying some sort of fee per year to get this insurance. But by buying that insurance, I have transferred the risk to the insurance company. So I'm paying maybe $1,000 per year, but that gives me the peace of mind knowing that if I should wreck my car or somebody should steal it, then I'm getting my money back from the insurance company. The insurance company, on the other hand, they're taking my money and of course a lot of other people's money into a big pool, and then they're taking over my risk and all the other people's risk, so that they are happy as well because they're getting money up front, and once in a while they have to pay up for a car that gets stolen, but that is a part of their business model. So when we are talking about options, it is actually an insurance that can be bought or sold. That's the core basics. Now it can be a bit complex, but when we are talking about options, there are actually only 4 different possibilities. You can be an option buyer or you can be an option seller. You can be buying or selling a call option or a put option. That is the 4 possibilities that we have. So let's have a look at it. If you are an option buyer, you're always buying the insurance, meaning that you're buying the right to do something, not the obligation. Because if I'm buying an insurance for my car and I get a scratch in my car, I have the right to go to my insurance company and tell them that they should pay something, but I can choose not to if I think it is not worth my while. So I always buy the right to either buy something or to sell something at a given price. When I'm selling something, I am taking over the obligation, meaning that I'm getting money for selling something, but I'm taking over the obligation. So if I'm selling an option, I am actually the insurance company, where I am selling, I'm getting some money in right now, but I'm obligated to cover a loss at some point of time if the customer wants me to cover it. That is the basic of it. So let's look at these 4. Now, if I'm buying a call option, then I'm buying a right to buy a stock at a certain price. Let's have a look at a chart to make it a bit more real life here. I'm taking the Apple stock here, and right now the Apple stock is at just around $315. Now, if I am bullish and I think that the Apple stock should go up in price to at least 340, then I could say I want to buy this stock cheaper, and I could buy a call option at the strike price of 320. So that means that I have bought the right to buy an Apple stock at the price of 320. So if it should go up to 340, then I can still buy it at 320 and make $20. Now let's have a look at what such a nice option would cost. I have here what is called an option chain, and I have the Apple option chain. Now, when we're looking at an option chain, there's always there's some different information here that we need to know. There is an expiration date, meaning that the insurance we are buying and selling is only running for a specific period of time. So here we can see that this option we are looking at here is running out the 19th of June 2020. All right, so that is about a month from now. Then we have the strike price, meaning at what price are we talking about buying or selling a stock here. And we have the price of the stock, that is the premium that is being paid. So if we're going back to the chart, we can see that we are at 315. We would like to, a month from now, to be able to buy Apple stocks at 320. So what would that cost us? Let's have a look. In the option chain, well, in a month from now, if we wanted to be able to buy the Apple stock at 320, we would have to buy or pay $7.70 per stock. And since an option is covering 100 stocks, then we would have to pay $770 for this option to buy 100 Apple stocks in a month from now at 320. Now let's look at the different possibilities here. Let's say that we pay $770 for this option and the stock goes down. Well, then the option expires worthless, because if it ends up in a month from now in 250, I don't want to buy it at 320. So that's not really something I want to step into. But let's say that it goes sideways. Well, then I might not fulfill the option here. I don't want to buy the stock at 320 when I can buy it at the exchange at 315. But I can make a lot of money if, for instance, the stock goes to 360, because I can buy it at 320. I paid $7.70 for the option, so my break even is at 328, just around there. So I'm making 328 to 360, that is $32 per stock, meaning that I'm making $3,200 because I bought the option here. So that is a concept of buying a call option. If you're buying a call option, you're bullish on the direction, meaning that you're thinking that some stock or ETF or commodity or whatever you're buying an option on is going up, and you want the option to buy it at a cheaper price. That is buying a call option. Then of course you can buy a put option, and that is the exact opposite. Buying a put option is an insurance. Let's say, for instance, that I think the Apple stock is going down. I might actually own Apple stock, and I think it is going down, but I don't want to sell it. There can be all sorts of reasons for that. But that means that I can buy an option so that, for instance, right now it is in 315, but I think it will go down in 300 or maybe even lower. So I want to buy a put option, meaning that I, in a month from now, can sell my Apple stock to $300, no matter how cheap it gets. If it goes down to $200, doesn't matter. In a month from now, if I have bought a put option, I can sell it to the opponent in the trade. I can sell it to $300, meaning that I'm cutting my risk. I don't take these entire risk down here. And there's some different reasons you could do that. But that is a concept of buying a put option. So if you are buying a call option, you're bullish on the direction. If you're buying a put option, you're bearish on the direction. And you want to make money on that direction. Now that is the option buyer. The other part, of course, is the option seller. And the option seller is taking on the risk. So if we're going to back to Apple, and we can see here that I'm sitting here as a potential option seller. And some guy approaches me. Of course, it's all done on the internet today. But I'm sitting here and I'm thinking that Apple should go down. Then some guys come along and say, I want to buy a call option on Apple at $3.30 in strike price a month from now. Would you sell that to me? Meaning that they would actually pay me for taking this upwards risk. And I'm saying, yes, of course I would like to sell it because I think it is going down. So if they approach me and say, we would like this $330 strike price, then we would look in our option chain and see what would they have to pay me. Well, they would have to pay me $4 per share, meaning they would pay me $400 upfront, money that is put into my account. But of course, I'm taking on a risk. So I'm getting $400 into my account. But if the stock should go up to, let's say, for instance, 360 here, then I have to cover in a month from now the entire range from 330 to 360. So I stand to risk $3,000, and what I got paid up front was $400. So I have to make sure that I am right pretty often here. So that is the call option seller. And then of course we have the put option seller. And that is a place where a lot of people have made a lot of money, but also lost a lot of money. Because what a put option seller is that we are having Apple here in an upwards trend. And I am selling the put option down here somewhere, maybe in 280, meaning that I'm getting money up front here now. Many people do this in stocks that they don't own, of course, but that they wouldn't mind owning. So if you're a big Apple fan, but you're saying, well, I'm not sure I would buy it at 315, but I would like to buy it at 280. Then you can sell a put option down here. And right now, if we are looking at the put option chain, you could get $2.40 per share, meaning for 100 shares, it's $240 you can get up front. Now, if the stock keeps going up, you just keep the $240. But if you are exercised, meaning that it drops down to $280, then you are obligated to buy the stock. But you don't mind because you actually wanted to buy the stock. You just thought it was a bit too expensive up here, but you thought that 280 was a much more fair price. So now you are actually getting money for waiting to see if the stock comes down here. And you can do that every single month as long as it stays above here. Let's say it went sideways here for 6 months. You could keep selling put options down here every single month for eternity, as long as the stock didn't drop down below 280. The second it did that at expiration date, you would be forced to buy the stock, but you wouldn't mind because it was a good stock and you wanted to own it. I hope that made sense. So again, back to the basics. You can buy a call, meaning you have the right to buy a stock at a certain price. You can buy a put, then that gives you the right to sell a stock at a certain price. You can sell a call, then you are obligated to sell at a certain price. And you can sell a put, then you are obligated to buy at a certain price. Now, if you're looking at the risk profiles here, it wouldn't come as a surprise, I guess, to you. If we are looking at a call options, and I should say these wonderful graphics I have from a website called projectoptions.com, I think it is. They have some very nice explanations and some very good graphics here. So that is the source of these. If you're buying a call option, as you can see here, you are limiting your downside, meaning that if you're buying the call option, in this case, for $500, then that is all you can lose, no matter how far. We have the stock price down here. No matter how far down the stock price goes, you can only lose your $500. If the stock price goes up, as you expect it to do, then we have the strike price at $100 here, plus the $5 that you have paid for the option, meaning that as soon as the stock price goes above $105, you start to make money and your upside is endless, meaning that if this stock goes up from $100 to $1,000 before the expiration date, then you are making the difference between $105 and $1,000. So there are no end to the possibilities here, and you have limited your downside risk. All right. The next part is buying the put option. Let's see here. Again, you're limiting your downside. Here you are buying insurance to the downside here, and your max loss is again $500 because that was the price you paid for the option. You cannot lose anymore. But if the stock goes the direction you think it will, then there is unlimited potential as long as the stock keeps dropping. Of course, it can only drop to zero, but then again, you would have made 150 times 100. That is $15,000 you would have made on a $500 investment. In a later video, I will get more into how these options are priced, because that is kind of a complicated matter where a lot of different factors are in. But right now, we just need to understand the core basics of the options trading. Now, this was buying a call, buying a put. Then we have here selling a put option, which is something a lot of people do, and they are taking on an immense amount of risk here. But when you are selling a put, in this case, you are taking in $200 into your account, and that's nice. And then we have the downside that is unlimited. As long as the price goes up, you are keeping the $200. But as soon as it starts to go down, you have unlimited loss potential. So, of course, you can also, if you're sold the put option and it starts to go in the wrong direction, you can also always buy it back at a more expensive price, of course. And then we have the last option here, the last possibility, and that is selling a call option. And that is, of course, that you are betting on the stock going down. You have a fixed income here as long as it stays below here. But as long as the stock starts to go up, then you are losing money. So I know it can sound complicated, but you always have to remember when we are talking about stock options and the different strategies I'm going to tell you about with covered calls and so on, then just remember that it is not more complicated than there is only 4 possibilities: buying a call, buying a put, or selling a call and selling a put. That is all you have to remember right now. Then in the upcoming videos, I will start to build some more knowledge on that. But this is the fact you need to remember. This you can print it out and you can put it on your whiteboard to remember this. And then we will put some more different strategies in, because there are a billion different combinations and strategies you can use when you are using options in your stocks. You can use it if you already own the stocks. You can use it if you want to own the stock but want to get in a bit cheaper. You can you can buy and sell options if you think there's going to be more or less volatility in the market. There is a ton of different options. So it is a bit complicated, but also a very interesting area to move into. But as I said in the beginning, if you are completely new to investing and you barely know what a stock is and how to buy and sell a stock, then you should not move into options. Options are for the bit more experienced investor that wants to get some extra layers on their investments and get some more opportunities. All right, that is all for now. Before you leave, please remember to subscribe to the channel, hit the like notification down there, and you can look forward to more option videos from me. If you have a request for me touching on specific option areas, then please write it in the comment section below. All right, that's all for now. Take care of yourself and take care of your money out there. I'll talk to you again soon. Bye for now.